And welcome to our webinar. My computer's assured me that everyone can see myself and my esteemed panel. My name is Andre Pouliot, and I'm going to moderate a discussion on property taxes for hospitality properties. That's going to be done by our property tax team here at Turner Drake. On the call with me, you should see us all across the top of your screen. We have Mark Turner, Nathan Hewitt, Greg Carey, Chris Job, and Giselle Kakamusius. So the focus of this was inspired by a lot of questions we've had from clients over the last couple of months. There are some clients are curious about what's going to happen with property taxes. There are some high expectations on what might happen, in a year as assessments are adjusted. And we've been fielding a lot of questions, and we hoped that we would do this webinar so that everybody could get get the real facts on when things are going to happen and what's going to happen. And we also hope to get a lot of engagement out of property owners who've been very busy keeping their businesses afloat and may not have had time to think about what's going to happen in terms of property taxation, this year and next year. So with that, the format of this webinar is going to be fairly informal. You're going to see our panel members kind of shut their screens off once in a while. We're hoping that's going to be less distracting. What we are looking for, we're looking for if anybody has questions during the webinar. We're going to run through a slide deck with fairly open conversation, and we're going to take questions as we go. Mark Turner is going to be moderating the questions that come in, and he is going to feel free to jump in and interrupt me or any speaker anytime there's something that's topical. If we don't get to your question on the webinar, we would certainly be happy to follow up afterwards. Everybody on this team would certainly be happy to answer any questions that come up today, tomorrow, next month, when you're doing your property tax budgeting, whatever. So that is so that's going to be the format. So I'm going to run our slide deck right now, and hopefully you're seeing the right screen. So we're going to start quickly with an overview of the impact on this disruption on hospitality properties. Our focus is going to be property tax implications. We'll talk a little bit about value, and I think everybody on the call knows that property values have been hit. They're all going to be to different degrees. So we're going to focus on the tax side of it. Obviously, there'll be some comments about value. But we can answer more detailed value questions later. A lot of it's speculation, but we can make some pretty good guesses for you. Again, this is Atlantic focused, so we're going to be talking about New Brunswick, Nova Scotia, PEI, and Newfoundland. And it's our intention at the end of this to follow up with some of the actions that we think should be required by owners. So, no secret here, impact on hospitality industry has been huge. Hotels, there's been a massive disruption to occupancy. We have increased cost, and what we believe is going to be a very prolonged, delay before we return to, pre-COVID-19 performance. We also look closely at golf courses. Golf courses, I believe most people are, and it depends on the course, but the late openings are going to impact your year-over-year revenue this year. Some courses are actually doing quite well right now, although the uptick in rounds played, there's been some changes required to, how you have to operate your facilities. So higher operating costs can mean lower values as well. Restaurants, same story. I think there's no surprises there. What we think is that long-term values are being negatively impacted by lower economic rents. So if it's harder to hit sales targets, that has an impact on rents. With more facilities becoming available for lease, there's going to be higher vacancies. And we think there's going to be a lot of perceived risk in the sector, which is going to negatively impact values. Now on the property tax side, there's a couple of things. If anybody's sitting here putting a budget together, I know everybody, Andre just said the values are going down. So we're all planning to see reductions in assessments and what we expect to be reductions in values. But a couple things you have to bear in mind, and we're going to get to them through this presentation. Assessments are point-in-time estimates of value. So as important as, what is the value, it's important to address when. The provinces, Nova Scotia, New Brunswick, and PEI do annual assessment. The Bay States vary. And Newfoundland does assessments every 2 years. So again, you're looking at some delay before the values that the impact that we've seen in the last few months is going to have on an impact in an assessment. The other thing, and the other big side to assessment, is tax rates. So we're all expecting to see reductions in values as COVID becomes a part of the valuation formula. However, we also have to look at the other side, which is the tax side. There's going to be tremendous upward pressure on municipalities to get more property tax to cover to cover increasing costs, and that's going to be, their ability to do that is going to be increased by, at a minimum, slower growth in the tax base, but in all likelihood, depending on the weighting of commercial and residential in the jurisdiction, there could actually be erosion of the tax base. So higher costs, erosion of tax base mean increases in property in the tax rate, which could offset any savings that you might see from lower assessments. And again, Bay State, and that'll be something that we'll deal with as well. That's going to dictate the when. So all the provinces have different Bay States, so that is key. Now I'm the New Brunswick guy. I probably do 60% of my work in New Brunswick. I see Mark's interrupting here, so he might have a question.
To interject, I'll save some of the questions for the end, Andre, but we did have one just submitted. It might be a good time to bring it up. This attendee says they own a restaurant where sales have dropped off quite a bit, but their rent is still dictated by the lease that's in place for a few more years. So if the rent hasn't changed, but their sales have, does that mean that the assessment is not going to change?
So that's actually an excellent question. So let's address the first answer. The first answer, let's take my slide that's up there now that says, if we're dealing with a 2021 assessment New Brunswick, we have to know what the property is going to be worth on January 1st, 2021. So if you're a restaurant that has seen its sales drop significantly because of the disruption, because of the restrictions on how you operate, while the landlord's going to get the exact same money, and that generally, purchasers buy a leased contract, but they buy that contract rent. For assessment purposes, what we're trying to do is establish what the market rent was on January 1st. So if that lease was struck, before something that's been fundamental as what we're going through, if that was struck before, then you're allowed to leave that rent out when you calculate the assessment and just look at what the prevailing rent would be. So that's a great question. I think, and that comes up in other cases as well. But that's a great question. I hope I answered it. And if I didn't, by all means, at the end of the presentation, somebody call me or email me, and we can have a long chat about it. But the answer to the question would be yes. You should, once it's relevant, you should challenge the assessment. So to close off on that New Brunswick slide, I guess I got to get the information in because of the question. But what we're looking at, if you're getting a 2021 assessment in New Brunswick, which you will get in October, everything COVID-19 related is a relevant consideration in the valuation, and you should aggressively pursue tax relief for 2021. So the next one popping up is PEI, and I'm gonna actually pass this on to Chris. Chris spends a little bit more time there than me, so Chris can fire up his camera and tell us about PEI.
Yeah, so similar to like Andre said, New Brunswick is an annual reassessment cycle in PEI. There is still currently an opportunity to appeal your property assessments, as the PEI government extended the deadline to the end of December. Typically, the appeal period runs about 90 days, but yeah, like I said, it was extended. The base date is January 1st, 2020. So technically COVID doesn't apply because that occurred after the base date. However, we'd still recommend that you appeal your taxes, because there may be some underlying issues that may be missed or have not been brought up that could result in a potential reduction in your assessments. As well, it would be an opportunity to proactively sort of bring up some issues and discuss the 2021 assessment. So even though technically COVID is not relevant, I would still recommend challenging the assessments and just to determine, sort of get an idea as to where you are and fully understand the calculations that are applied to your property.
Just popping into the screen here with another submitted question, somewhat property related, but also province related, because there's so many of these properties in PEI. So the question is about golf courses in general. Golf courses, now that they're open, many of them are doing very, very well. So the question is, does that mean if the courses are doing very well right now, that they can expect the assessments of those properties to go up?
Well, not necessarily. Because I mean, golf courses still missed out on the first 2 months of the year, much like any other business. And there's been so much pent up demand that it's no guarantee that the assessments will increase, and that's it just puts a more impact on taking a closer look at your statements. And there's always a trickle down effect too. So a lot of the people that are attending are going to the golf courses, they're local, and they may not be spending as much at the dining facilities, or they may not be staying over at any of the lodges if it's connected to a lodge. So yeah, there are other sort of underlying impacts that may not be addressed, and it's all pent up demand, similar to, and just going off of hospitality with dealerships. They were closed for 2 months out of the year, and now there's an uptick in sales, but that uptick may not last the whole entire year. It's just pent up. So again, it's something that we'll consider in our valuations when we're putting forward either budgets or projections for taxes for the coming year. And I'm not sure if Giselle wants to piggyback at all on the golf course discussion.
Yeah, that's good. I actually, and the next slide up's Nova Scotia, and Giselle's is quite versed in Nova Scotia, and I think I just know personally tackled a number of courses over the last couple of years. Giselle, I think I won't steal the thunder, but have we lost one yet? I don't think we've lost an appeal on a golf course in the last several years. So take it away.
No, I think with golf courses, I think that there's ample market evidence to show that even prior to COVID, a lot of courses around the province and the region really were over assessed to begin with. I think we launched probably between 10 and 15 challenges for the 2019-2020 assessment years, and of course that's in a different universe. The COVID wasn't even on the horizon, and most of those came down between 20 and 50%. So definitely some opportunity for course owners. But in Nova Scotia, we're going to have to wait a little bit for COVID-19 to be technically relevant for assessment purposes. We have a January 2020 valuation date, so we're going to have to wait until 2022 before COVID is fully reflected in assessed values. That said, I'll repeat the refrain from your presentation and from Chris's. I do think that many properties are going to warrant challenge for 2021, and the first opportunity to do that is going to be this fall. And when I say this fall, some of you on the webinar may not be aware that Nova Scotia pre-publishes its assessment roll each fall. PBSC's assessors are willing to discuss values before they go on the formal roll, which doesn't happen until December the 1st. And this consultation in advance of the mailing of the notices is a process that's endorsed by everybody, all stakeholders, the PBSC, the municipalities, and taxpayers. It's a win-win because as a taxpayer, you have the benefit of securing a fair value. Oh, sorry, my mute's not on there. You have the benefit of getting a fair value anyway without the time and expense of a formal appeal. The municipality gets budgetary certainty around the roll. PBSC frees up time that would otherwise be spent on appeals. And as a consequence, we do hundreds and hundreds of accounts this way every year, and it's to the benefit of everybody. But again, in spite of the fact that COVID won't be relevant until 2022, I think that 2021 values deserve a hard look. Visitors and tourism revenues were down 4 to 5% in 2019, and there's obviously some considerable variation around that average, particularly on the South Shore. The ferry wasn't operating. And with market cap rates staying constant between the Bay States, my take is that many values should probably come down even prior to COVID-related concerns. I think there was modestly heightened risk facing the industry relevant to the 2021 Bay State from other factors, and these should be considered in striking assessments. Bookings on the sharing economy, Airbnb and so on, were up about 40% in 2019. The Yarmouth Ferry, as I mentioned, wasn't running. Boeing MAX aircraft were grounded, and air traffic was down by 8% in Nova Scotia in 2019, so that's a factor. Hurricane Dorian was also a disruptor in the fall. So for assessment purposes, a lot of these factors go to risk, which in turn goes to cap rates. And we haven't seen any changes in assessors' cap rates for a number of years, and I'm thinking that it's probably time for that in 2021. Bottom line, I think there are probably some knobs to turn, some opportunity even before we turn the page to 2022, which is when COVID will be front and center. And again, I know we have some golf industry participants on the line. I do think that this is especially true for golf courses because there's ample market evidence to show that many are assessed at above market value to begin with going into 2021 and 2022. I'm not going to be so bold as to say that's universally true, but certainly it was for the courses that we reviewed. Another benefit in challenging your 2021 assessment is that it provides you with an opportunity to open a dialogue with PBSC respecting the impact of COVID on your business. PBSC wants this information because it's going to help them in setting 22 assessments for your property as well as others when the time comes, which is going to be in another year to 18 months. So what do we think is going to happen for 2022, and where do we think assessed values might go once COVID is a consideration? I'd say that, with over half of Nova Scotia visitors are coming from outside of the Atlantic bubble, it's reasonable to assume that revenues could decline by 50%, maybe even 75% in calendar 2020 for many operators. And I think it's probably going to take, or at least what I'm hearing is that the thinking is that it's going to take 3 or 5 years to come back. We've been speaking to some industry participants and investors, and it's predicted that we're probably going to see a 50 to 150 basis point premium on cap rates in the short term. And to give you some context for that, 100-point increase on a downtown hotel, for example, would have a 10 to 15% downward effect on value, and that's even before revenue and decreased revenues and other operating leverage or related factors are considered. What the challenge is going to be that assessors and our job is going to be made more difficult by what I anticipate is going to be a shortage of market sales. We don't have a crystal ball, but what we do have is a rear view mirror. And I think that the experience of SARS and the 2008 market crash and even the deep recession of the early 90s, for those of us who were working in the industry at that time, provide us with some guidance as to what we can expect. I think it's probably a short-term correction of 20 to 30% minimum, and I'm hoping that this is going to be reflected in assessments in Nova Scotia. Obviously, it's going to be starting in 2022. You mentioned
have a question come in here, if I can interject for a second, Giselle.
Sure.
And the question is somewhat related to PEI, and I know the person that submitted this is in PEI, and the reason I know that is because the question says on PEI and not in PEI, and I find only Islanders say on PEI. So the question is, on PEI, assessments are known to be low. He's wondering how PEI tax rates compare to Nova Scotia, New Brunswick, and Newfoundland.
The tax rates? Tax rates in PEI I guess it really depends if you're talking about in the centers or in the secondary locations. Tax rates are relatively similar. Assessments are low, tax rates are similar. So I think on balance, taxpayers in PEI are probably paying a little less for any given property type. So if you have two like hotels, downtown hotel in Charlottetown, downtown hotel in Halifax, you're likely paying more in Halifax, and that's a function of a higher property value really than it is on the tax rate, because the tax rate in downtown Charlottetown is quite similar to, maybe even a little higher than it is in Halifax.
And his follow-up question was, has Turner Drake ever had success negotiating a lower tax rate?
Tax rate? Well, that's kind of a funny question. There is, in PEI, there's an opportunity to, particularly on hospitality properties, and this is a very important consideration, actually for golf too. PEI has commercial and non-commercial tax rates, and hotels, the only portion of a hotel that gets assessed commercially is the dining room and the hallways and so on. All of the rooms are non-commercial. So you can get the overall tax rate reduced by altering that split between the commercial and the non-commercial. Same sort of thing with the golf course. The lands are assessed non-commercially. So there's some play there. In terms of the actual published rates, no, but in terms of the effective rate applicable to a property, yes.
I can't let you know yet because I've got two other questions here.
Okay.
One of them says, recognizing that owners are facing cash flow challenges today, what can they do to have their assessment values reviewed in 2020 for Nova Scotia?
2020, if you don't have an appeal, there's not a lot you can do. There are some mechanics in the Assessment Act that might allow for corrections of errors and this type of thing. But if you don't have an appeal for 2020, unfortunately, there's not a lot you can do. Some municipalities, and we'll talk about this in a few minutes, are offering some holidays on tax arrears and extending some appeal deadlines and so on, but none in Nova Scotia, actually, because the appeal period is passed. So you're really looking forward to 2021, but you can do that probably starting in September.
I have a couple other questions, but maybe what I'll do is let you roll on just so we don't interrupt the slideshow, and maybe I can ask those again in a moment as we proceed.
Sure. Yep. I'll just sort of roll through the rest of what's going on in Nova Scotia, and then we'll move forward. Mill rates have obviously been a hot topic today, and obviously there's recognition from our participants that assessments are only one side of the equation, and as Andre mentioned, municipal budgets are under substantial pressure. The hands of the provinces and the municipalities in terms of their ability to provide relief are kind of tied by legislative authority, and that varies from jurisdiction to jurisdiction. There have been some relief measures rolled out, and we've done a fairly comprehensive survey of those, and you can find them on our website. I don't know if you've got them on the slides there, Andre. You could pull them up or not. Anyway, at the end of the presentation, we can provide you with the link, and we've surveyed pretty much every major jurisdiction in Atlantic. All right, so that's it in Nova Scotia. You're going to want to take a look first in 2021, even though COVID's not relevant. I think there's some other factors that might see some downward pressure on values. Definitely 2022. You should be taking a long, hard look and turning those knobs. Newfoundland. Newfoundland is not a great place for a hospitality owner hurting from COVID. There are two taxing or assessing jurisdictions in Newfoundland. The Municipal Assessment Agency handles everything outside of the City of St. John's, and then in the city proper, it's handled by the City of St. John's. You're going to have to wait until 2022 outside of St. John's, and all the way to 2024 in the city proper. That said, appeal periods are open right now for 2021. My colleague Greg has a better pulse or finger on the pulse of what's going on in Newfoundland. So maybe Greg, I'll turn things over to you to provide some comments in terms of when are those appeal periods in, and then really what are you seeing in terms of hospitality assessments?
So yeah, like Giselle said, the appeal period in Newfoundland and Labrador is open for both assessment jurisdictions. So basically there's the City of St. John's is responsible for their own assessments. Then everywhere else in Newfoundland and Labrador is handled by the MAA. So the MAA appeal period is open right now until July 31st. So you've got a week and a very small amount of change to get an appeal in if you're interested in challenging your assessment. And in the City of St. John's proper, it's open until August 14th. And more broadly speaking, in terms of assessments in Newfoundland and Labrador, what we've seen, at least with hospitality properties outside of St. John's, is things are mostly flat or declining very slightly. However, based on the tourism numbers, it looks like that may not have been enough. What happened with tourism numbers, both aviation travel and via car, overall visitations were down from 2017 to 2018, and again in 2019. Spending was down likewise. So really, it looks like the tourism industry was already, on its back foot. Not to mention the price of oil prior to COVID-19, which has hammered it even further. But that's already hurting. That's hurting an already weakened industry. So broadly speaking, challenging your property taxes looks to be the smart play outside of the city of St. John's proper, under any assessment struck by the MAA, but as well in the city of St. John's, those tourism numbers obviously have a huge effect there as well. So across the board, things were looking down a little bit. So you'll want to review your assessments just to ensure that, those are your operations are reflected in your assessment, because obviously what you do in business is going to be reflected in your hotel, golf course, restaurant, that sort of thing.
All right, thank you, Greg. So there's one idea, one sort of concept that it was the questions that made me think about this, and I just want to reinforce it before we go anywhere. The comment about assessments being less than market value in PEI is universally true. Assessments are very conservative, but what you have to remember is everywhere other than New Brunswick, there are uniformity provisions in your Assessment Act. So in theory, if I own a hotel and my values have been devastated by COVID, and we're looking forward to the next year, and you know what, maybe there's other types of properties that haven't been. Not all properties are going to be affected equally. If I'm at 65% of market value or 60% of market value today, and the assessment roll is completely rejigged for next year, and all of a sudden I'm at 95% of market value while everybody else is at, my competitors are at 75, or not just my competitors, but globally at 75, we have a pretty good case to get assessments reduced. You have a statutory right to be treated fairly. So I want to make sure it's clear, because I know in a lot of cases when we talk about PEI, sometimes we talk about Newfoundland, we talk about uniformity and the fact that, well, gee, my value is more than what my assessment is. So it's important to understand uniformity, and it's important to understand uniformity across classes. There's only one rate, so it's important to understand them across classes, not just within them. So I just wanted to, to nail that. So yeah. So Mark, you got one more question there, or?
Yeah, there's another question here. Oh, the second one has just popped up. So, and the question is regarding the use of financials to assess property. If two similar properties are operating with different levels, presuming that means different rents and or expenses, if one is operating, physically they're the same property, but one is doing better than the other, aren't you penalizing the one that's being run better by having a higher assessment when they're already paying higher in terms of corporate tax?
So I'll take it. We're kind of getting out of the wire, but the answer is you're not going to be penalized for being a great manager. You're not going to be penalized for having a stronger brand. Properly synthesized assessments would distinguish between those. So similarly, you're not going to be rewarded if you're a poor manager. So if you're, and there's techniques to do this. So again, focus on like for like. If there are like facilities that are, assessed at, let's talk about land and buildings, assessed at a lower rate and it's consistently lower, then it's absolutely a reason to contest your values. So yeah, hopefully that answers it. As we get down here to the wire, my clock says 1:30, so I'm going to leave you with the action required. And the action required is to be proactive. It doesn't matter what jurisdiction. It doesn't matter in my mind if it's a COVID, if you can get COVID in now or COVID in later. You should sweat the details this year and sweat the details at the next available opportunity. You can ask anyone on my team to give you a quick overview and make sure there's no exposure for you. But I think a lot of us, when business is going good, we tend not to look at expenses closely. So I think, given the circumstances, even if it's a pre-COVID assessment, I think you should sweat the details. There's still opportunities, PEI, there's still opportunities in Newfoundland to file appeals, and everything, and your next opportunities in Nova Scotia and New Brunswick start this fall. So that brings us to 1:31, and we started at 1:01, which is exactly 30 minutes. We promised we'd only take 30. So with nothing else, our contact information is all on the screen. I'd encourage anybody that didn't get a question answered, and we'll look at them and follow up with them after. But if you don't get a response fairly soon, I'd encourage you to reach out and ask away. Thank you very much.